My name is Mary Biddle-Koenig, and I am the Program Director of the Smith Enterprise Risk Consortium, or SERC, as we call it. I would like to welcome you to our U.S. at War Executive Perspectives on Risk in 2026 webinar series brought to you by SERC, which is at the Robert H. Smith School of Business at the University of Maryland. Today's event is the first in a three-part series sponsored by ZRG Partners Risk and Compliance Practice, discussing the implications of war, beginning with today's topic of macroeconomic impacts, and then moving on to energy infrastructure and supply chain risks in April, and cybersecurity and technology risks in May. So stay tuned for details. For a bit of background, CERC was an initiative launched 2 years ago by the Smith School to build a community of risk practitioners to share lessons learned and cultivate best practices. It is based on the premise that not only is there much to be learned from practitioners that have been there and done that, but that lessons learned in one industry can be applied in another. As such, the CERC community is comprised of companies across industry sectors, including financial services, pharmaceuticals, insurance, technology, and aerospace. We have established an amazing advisory council, including companies such as Northrop Grumman, Arch Capital, Google, AWS, and Travelers, and a network of senior risk experts that work with us to ensure that our events and training are targeted and provide real value to practitioners like yourselves. We have 3 events coming up in the next several months. First is a 2-day virtual workshop, excuse me, called Gen AI and Risk, Balancing Innovation and Risk to Build Value, which is on May 14th and 15th. Shortly thereafter in June, we will kick off our CERC Risk Academy training for mid to senior risk managers, which will be offered virtually 4 hours a week over 8 weeks, where participants will earn a professional certificate in risk management from the University of Maryland. Then finally, our flagship CRO Risk Summit for senior executives will be in Washington, D.C. on September 17th. Through all of these events, we're bringing together risk practitioners at all levels so that risk management doesn't always have to be learned on the job. Now, with that as background, I would like to introduce the director of the Smith Enterprise Risk Consortium, Cliff Rossi, who will be our moderator today. Cliff is a former risk practitioner with decades of experience in risk management at some of the largest financial institutions. He was instrumental in the launch of CERC in June of 2023 and its continuing success today. Now I will turn it over to Dr. Rossi to get us started.
Thank you, Mary Biddle. And we're still awaiting one of our panelists, Mark Zandi. So I'm going to preamble a little bit, as I would have even if he had joined uh, at the beginning of this. But let me just kind of set the stage here. We are in the midst of one of the most consequential military actions since the Afghanistan and Iraq wars. And in some ways, this has even more far-reaching repercussions globally than those conflicts, given the closure of the Strait of Hormuz and all the damage that's been inflicted to oil storage, refining, and extraction infrastructure around the Middle East. And so, we see headlines every day. In fact, today is yet another set of headlines where maybe there's a shift in the direction of things, showing major damage being inflicted on Iranian military installations and leadership. And yet we see the Iranians at this point effectively holding the world hostage, economically anyway, using relatively low technology equipment like drones and fast boats and such to keep the world's largest military at bay from allowing the strait to open up. So let me toss out a few sobering statistics to keep in mind in all this. So right as farmers in many countries are starting their planting seasons, about a third of urea shipments are held up in the strait right now. Prices of urea have skyrocketed consequently by 50 to 70%. Natural gas shipments, which are also an ingredient to nitrogen fertilizer, have likewise faced drastic cutbacks in shipments. About 30% of global helium supply has effectively been taken out when Iranian missiles damaged Qatar's LNG facilities, causing prices to spike there about 70 to 100%. This has significant knock-on effects in the production of semiconductors and data centers that require cooling and sterile environments. Aluminum production has also been affected by damage at various production facilities, causing price spikes and shortages. And since the beginning of the war, just about a month ago, oil prices have surged. And I just did the calculation this morning, so I don't know where they've landed at the end of today, but they've surged 67%, with prices for Brent crude at somewhere, at least by this morning, of about $117 a barrel. So clearly, the conflict has major implications for global economies and markets. So we'll dive into this. And so our panelists today, we have here in person right at the moment is Sayee Srinivasan, who is the chief economist at the American Bankers Association. Decades of experience, was at the CFTC for a number of years, and we should be joined shortly by Mark Zandi, the chief economist at Moody's Analytics. Again, both of these are very well established, well known economists that will be giving us their views. So thank you, Srini, for Sayee, for being here today. I appreciate that, and I know Mark will join very shortly. So I'm going to comment a little bit. Mark actually had a little bit of a head start on this. He was pretty well equipped for this webinar to begin with, and I think that's one of the reasons why he's maybe a little late to our party, only because there is there he is. I invoke his name, and so he appears. Mark, welcome. Appreciate you being on. I was just telling folks that I think you're probably a man in demand as well these days, particularly as I was about to cite your piece, the Iran oil shock. I just gave a little preamble on sort of to set the stage on where things are and a few kind of like interesting tidbits and statistics about what's going on around various commodity prices and whatnot. And I know, Saeed, for you must be fielding an awful lot of questions from your members on how all this is going to play out in markets. So my first question on this is what are your views on the likely outcome from the war? And I kind of put it into these buckets, and feel free to kind of modify these buckets as you deem appropriate. One of them is a quick end to hostilities, and if you look at what happened to the market by the end of today, you'd probably say maybe it's going to be quicker than what we saw in the last week or so. I don't know. Medium term engagement, quagmire. And then how would you handicap those scenarios? So maybe Mark, I'm going to put you on the spot and have you maybe kick us off first here and turn to Saeed.
Well, thank you for that, Cliff. And I apologize for being late. I was on time, but somehow I just couldn't click in. I don't know. So and I apologize for this. I'm on my cell phone now, so that's
no worries.
Yeah,
It all works out.
And let me preface everything I say today by the fact that I've been an economist for a long time, Cliff. Maybe not as I think I'm in the same generation as you. I've been an economist for 35 years.
Yeah.
And in that, and I've seen a lot of business cycles, and through a lot of different business prisms. But in that time, there's only a few times where I've been as uncertain about the economic outlook. I mean, there was 9/11, there was Y2K, there was the GFC, there was the pandemic, and then there's now. So I think got to be humble here about all of this.
Yeah.
But a lot rides on that very question you asked about how this is all going to play out. Now, my baseline assumption is, and that's in the middle of the distribution of possible outcomes by design, is that the president will stand down, declare victory, move on, if not in the next few days, certainly in the next few weeks, by the end of the month. If that's the case, then we're pretty close to a peak in oil prices. Say oil, Brent, I saw today got to 120, maybe we get to 125. On a specific day, you might get higher because of events, but we're near a peak. It's going to take a while to open up the strait and get oil flowing, but by June, we're mostly back in terms of oil, and the price settles in around $80 a barrel by the end of the year. There will be a risk premium built into price for a long time, just because insurance companies are going to want more, traders are going to expect a lot more uncertainty. You got the Iranians still potentially closing the strait again in the future. So if that's the baseline, then it's going to feel uncomfortable. Growth is going to be much slower this year. Inflation is going to be much higher this year. Unemployment is going to be closer to 5 than 4.5. But we should make our way through without a recession. I'd put odds of that around 60%. I don't see any potential upside here. There's no upside scenario, at least not with regard to the question around Iran. There's other upside possibilities, but not with regard to what's playing out in Iran. It's all downside. So I say there's a 40% probability that I'm wrong. This thing goes on for longer. There's more hostility. There's more disruption. Oil prices go higher, stay higher for longer. We go into recession. So 60-40. And by the way, I'll end by saying we have a a model, a leading indicator model based on a random forest algorithm. It's done a pretty good job historically. I'd say probably too good because maybe it indicates we're overfitting. I don't know. But, I'm increasingly putting weight on the model, and the model says as of the month of February, 40%. So, and that's before the Iranian hostilities engaged. So I'd say the most likely scenarios we make our way through, but I don't say that with any confidence. And if I'm wrong, we're going into recession.
So if I were to rewind, that's very interesting. So if I were to rewind that, you're thinking that the baseline again is this gets resolved in the next few weeks.
Yeah.
And but there's still some lag effects that occur through into like the summertime, but we're going to drag this out into a long-term endless kind of war.
Got it.
Yeah, is that pretty much what it is?
That's the baseline. Yep.
Sayee, how do you square with what Mark is saying? Is that sort of consistent with what you're seeing, with what others are kind of like discussing with you?
Yeah, so once again, as the usual disclaimer, as Mark, this is my views, and fortunately, Mark does forecasting for a living. I don't do that, but I do sort of
Sayee,
benefit
we all
from.
forecast for a living. Everybody forecasts all the time. That's all we do all day long. Everybody. Yeah.
Exactly. But so it's like I agree completely with Mark. And if you see, there is this consensus view, and one of the things I've been tracking is the term structure of crude, right? Brent on the futures market for crude. And I think the consensus, and you've seen some pick up in activity there. But at the end of the day, it's still sort of a downward sloping curve in terms of the term structure. And what that indicates is that the market is expecting that this is something which will get resolved. But you're not going to see crude prices go to, sub 40. It will be sort of higher. And that's the expectation for all the reasons. In terms of the impact on the sort of the US and sort of the global economy, this sort of we are in this very odd place because it's such an asymmetric impact, right? The immediate impact is so asymmetric. The US is very well protected. We are self-sufficient in terms of natural gas and crude, especially natural gas. So we haven't had the impact which the rest of the world is, in Europe and Asia and others are dealing with. So yeah, so we are protected, and you go look down south of the border in Mexico and Brazil. They are sort of similarly situated. So the closer you are to the Middle East and the Gulf, the higher is the dependence and higher is the impact, I guess. So it's sort of this asymmetric impact, and so the question is, how does all this work out from a longer period of time? I think and this is something we have seen, right? The muscle memory of businesses is, pretty strong here, right? You have the COVID and all the supply chain shocks, and then you had the invasion of Ukraine, where you had the same fertilizer shortages and everything that people had to deal with. And then beginning of last year, from April, just about a year ago, we had the tariff shocks that hit the world, and once again, supply chain and shipping and everything else had to be recalibrated. So my presumption is that businesses, I don't know how good a job countries are doing in terms of risk management, but companies are doing, I'm surely doing a very good job. They're on it in terms of risk management, in terms of preparing for these shocks. You don't know where it's going to come from. And to the extent they're spending more resources on risk management rather than actually building for long term and investing, I think this just raises the cost of growth, I guess. So I agree with Mark. I don't see any tailwinds for growth, unfortunately. So we can talk some more about, if you take the AI investment out, where the US is, but that's where we are. So.
Yeah, no, that but what both of you are saying, I mean, it's Sai in particular. When you're talking about these, the tariff impacts and Ukraine and all this, I mean, the global economy has been actually, in my mind, shockingly resilient, given all these things, but that it hasn't tipped into some sort of like dark place. But it seems like it's still holding up, and maybe the U.S. holds up even a little bit better. But Mark, if you know, kind of taking that theme a little bit further on sort of where we go from here, so to speak. Um, that piece that you wrote, on the oil shock. What's your model telling you how things look like by the end of this year in terms of just growth? How slow a growth are we talking about, baseline and then versus around that baseline?
Well, in terms of GDP growth, the value of all the things that we produce, Q4 to Q4 in 2025, it was 2%, down from 2.4% in 2024. And if you told me Q4 to Q4 we're at 2% in 2026, I say that sounds about right to me,
Hmm.
which is good in one sense. It's positive and it's 2%. But it is disappointing because the economy's potential is somewhere between 2.5 and 3. And so unemployment will continue to drift higher. So by the end of the year, the unemployment rate, which is now closing in on 4.5, will be closer to 5, which I think most people would consider disappointing, uncomfortable. That's well above most estimates of full employment, which are centered around 4%. In terms of job growth, I think it's going to be very disappointing. At best, we get slightly positive job creation, maybe no job creation. In 2025, we ended the year, coming into 2026, we've ended the year with no job creation. In fact, there's been no job creation since Liberation Day, the tariffs a year ago. So when you say we've been resilient, yeah, in some sense, but in other senses, including jobs, we have not been. We've been hurt pretty badly by that particular policy. So I think, and that's the baseline, right? That's where we don't suffer a recession. President, figures out a way to declare victory and move on here pretty quickly in the next few days, next few weeks. I think there's a lot of risk around even that scenario, but that is the baseline scenario. Outside of the risks related to Iran, there are many other risks. So, and I think the risks are skewed to the downside at this point.
Yeah, yeah, I would agree with that.
Can
You
I
touched
ask,
on, yeah, go ahead,
Mark,
Steve.
in your GDP forecast, how do you factor in the AI-driven component, I guess, as a driver?
Well, AI is lifted GDP growth in calendar year 2025 by almost a half a point. So we grew, calendar year a little over 2. Without AI, we would have been. Cliff would not have been saying, it feels like we're resilient. It would have felt
Right.
measurably more uncomfortable than what we experienced.
Okay.
That's on the demand side of the
Right.
economy. On the supply side of the economy, it's been very modest. I think the productivity gains hard to measure.
Yeah.
Again, got to be humble here, but the evidence suggests that very modest pickup in productivity related to AI. Some pickup, but very modest.
Yeah.
And by the way, that goes to one of the risks to growth in 2026, particularly around jobs, and that is, what if AI kicks the productivity side of AI, the supply side of AI kicks into a higher gear, and we start to see bigger productivity gains? You could actually see some outright job loss, all else equal, in 2026. So I view that as a potential downside threat to growth, in specifically job growth in 2026.
Okay, so and you were commenting a little bit earlier on the inflationary impacts of this, right? So you've got Warsh coming in. The market had been thinking, of late, well, earlier, I guess, a while back, it had been that there might be a couple of cuts or more. Now it sounds like maybe no cut, maybe possibly an increase. I mean, where do you land on this? I mean, the Fed's they've got a tough job here. Sayee, I mean, the banks really care about this a lot too, as well as everybody else. But what are you seeing?
Yeah, so it's interesting. The Fed has been saying in recent days that They think that the shock is going to be short term in nature and is transitory. They don't use the term transitory anymore, but that's the implication. But to Mark's point earlier, if we are anticipating that crude prices will be in the $80-$90 range for longer, then that is no longer transitory, right? So that sort of makes it difficult for the Fed to see prices going down in any material fashion. So I think that is from a industry perspective. I think I don't think we are really short of. There is funding, there's liquidity available, there's still risk appetite, and but at the same time, given where we are for all the reasons that we've been talking about, people are just holding cash. So that sort of the the joker in the room is credit quality.
Mm-hmm.
Right. So yeah, to your point, bankers, if you're in the lending business, then and maturity transformation, like a good upward sloping yield curve, and we can sort of what we had in 2025 was a good year for the industry, if you're in that business, and if we can continue with that through 2026, nobody's going to be complaining. But I think on the other side of the balance sheet is what's happening with credit quality, I guess. And it's directly related to the health of the labor market. And as unemployment goes to closer to 5%, then I think people are going to be worrying a lot about credit quality and delinquencies. And the story will change at that point. I don't know, Mark, I don't know how you look at it.
Well, I think the Fed, as you said, Cliff, is the Fed's in a very tough spot. The response, the initial response is to just sit on their hands, do nothing. Just like they did with the tariffs. There was too much uncertainty. They didn't know how that was going to play. And then they sit back and wait to see, which of their mandates, which of their objectives is most at risk. Is it the full employment mandate, or is it the low and stable inflation mandate? And in the case of the tariffs, they decided, it's the full employment mandate. Growth is slowing, unemployment's rising, therefore we're going to lower rates. In the current context, they're going to wait and see, and which of their mandates is under most pressure. My sense is it's going to take them a lot longer to figure that out because growth is going to get hurt. We just discussed that, but inflation is now higher than it was a year ago, and the direction of travel is for even higher than where we've been. The consumer expenditure deflator inflation is now 3%. That's a point above the Fed's target, and the thing that I think is going to decide it for them is inflation expectations. If they feel that inflation expectations are coming unmoored. And so far that hasn't happened, but it's not unreasonable to be worried about that because inflation's been above their target now for 4 or 5 years. People are beginning to wonder reasonably, is 2% really a target? What is that exactly? And if that's the case, then inflation expectations come on board, they will raise rates. In my view, they will sacrifice the economy to the altar of low and stable inflation because they realize that if they don't and inflation becomes more of an issue, they're going to have a recession anyway. So why not take it up front and just, go get inflation back in? So, my baseline forecast, I'm assuming they sit on their hands all the way through into next year. And then ultimately we're on the other side of all this mess. Inflation is coming in and they resume lowering rates, but very slowly. And, I say that with I wouldn't argue with anyone who said to me, no, they're not going to cut rates next year either. Only because I think the equilibrium yield, the R star, that rate at which policy is neither supporting or restraining growth, is probably higher than 3%. It's probably closer to where they are now, the 3.5%. And that's certainly the case if you believe that artificial intelligence is going to kick into gear and provide, a pickup to long-term potential growth, because that ultimately determines R star, the equilibrium yield. So if AI is going to add more to productivity and we're in a world of higher potential growth, then the equilibrium yield should be higher. So bottom line, I think they do nothing through this year into next. And I do expect them to lower rates in 2027, but I don't say that with any confidence.
Got it. So do you think that we get some resolution here in the next few weeks to your baseline, maybe that like the U.S. Treasury comes down back to where it was at the outset of the conflict?
Well, you mean long-term interest rates?
Yeah.
Well, yeah, I mean, if the baseline happens and the president declares victory in the next few days, next few weeks, then I think yields will come back in, but not a lot. I mean, we were sitting around 4%, maybe a little south of that.
Yeah. Mm-hmm.
And in the long run equilibrium funds rate is 3.5%. The long run equilibrium 10-year yield is 4.5, 4.25, somewhere 4.5, 4.5%, somewhere in that range.
Mm-hmm.
There's a 100 basis point spread typically between the 10-year and the funds rate. So if you think the equilibrium funds rate is 3.5, you would think the 10-year yield is 4.5%. So I wouldn't, if I'm in the real estate business and I'm trying to think about, if this investment pencils out, I don't think I'd be, I think I'd be assuming something around where it is right now in the long run.
Yeah, because we saw 30-year mortgage rates. What are they at? Like 6.5, 6.6 or something like that. And they were just underneath, I think, 6% before this all started, and we saw some pullback on demand. So I imagine, Sayee, on your side, you're probably having some folks that are doing mortgages kind of scratching their heads what's going on. But again, to Mark's point, maybe this is just a blip and we get things kind of through this in the next few weeks and it somehow kind of modulates back to where we were. Something I want to say to the audience out there, I've got a question that's come in. I'm going to reserve that to the last 15 minutes to kind of open it up to everybody who'd like to ask the panelists some questions. But if you'd like to put them into the Q&A portion of the Zoom here, we'll take them and kind of pass them along to folks. So let me kind of focus. I think, Mark, I heard you say back early on in this session that we'd have to see oil prices hit like around $125 a barrel before we see some really damaging effects. Is that pretty much about right?
The way I would frame it, Cliff, is that if you're asking me what would it take to push the economy into recession with a reasonably high probability, I would change my baseline forecast to a recession scenario. Would be where oil prices measured by Brent are $125 on average through the second quarter. So that would suggest that we've not resolved this thing, through the month of June. We're sitting on July 4th, and that's when this thing gets resolved. If it lasts that 3 months and 125 on average, that means you can get to 140, you can get to 150 for a day or two or a week. I think we're done. We're going in.
Okay.
Hey, Mark, can I ask you a question? So this is from the perspective of the U.S. economy, right? But countries in Europe and in Asia who are more dependent on natural gas and crude coming from the Gulf. To the extent in Qatar and other places, there's been some real physical damage that has happened to capacity. Those countries are the story is different for them, right? Even at these current prices. Supplies, even at you keep reading reports that you see these prices being quoted on Bloomberg, but it's unclear that you can actually get any of the supplies of those prices. And jet fuel, in some sense, the stock that's there, they will run out of the stock in a month or less. So some of those countries could be dealing with issues for much longer. They might actually get into a recessionary phase much faster than the threshold for them in terms of crude prices are very different than the US, I guess. So I'm just to what extent, if that being the case, to what extent will some of those risks sort of impact the US, I guess? If the rest of the world is slowing down in a bigger way, will that impact the US?
Well, I think you're right. I mean, the U.S. is more insulated to the fallout than the rest of the world because we produce as much oil as we consume. The initial effects of an oil price hike are negative because consumers get hammered right away and they pull back. Producers benefit, but they don't benefit they don't act on the higher price for a while because they don't know the price is going to stick around, and they don't make investment in higher. In the long run, if the prices stay high, then yeah, you will. It'll all be a wash in the U.S. In fact, there's only one country on the planet that actually benefits from all this. You want to guess which one? Do you have a sense of that? Cliff, which one is it?
Russia.
Yeah,
Russia.
that's the only country on the planet that benefits. Norway gets a GDP bump, but it also suffers higher inflation. Everyone else is getting nailed.
Yeah.
So yeah, I think you're right. I mean, the one caveat though is in much of the rest of the world, governments cushion the blow. In the U.S., gas prices go up immediately. Diesel prices go up immediately. In the rest of the world, most everywhere else in the world, the government, it's more highly regulated. The government subsidizes. It shows up in a more significant fiscal problem for those countries. But it cushions in the U.S., prices rise like a rocket. In the rest of the world, they rise much more slowly. But I think your point's well taken, and it will reverberate back on the U.S. Through trade and through you can see it in the value of the dollar. The dollar has appreciated in value. So I think that does have a meaningful impact. But the rest of the world is at more risk than we are for sure from all this.
Hey, Mark, I used to be a consumer of all those great Moody's scenarios, and I used to look at some of those stagflation and oil price shocks and go,
never
know what to do with these. This is back in the day, but now I think they're quite relevant. So, very, very prescient of you to, put those in there, right? But, I had a question that did come in here, and it kind of reminded me because we're talking on this issue about sort of what the impact of maybe some of the, the knock-on effects from other economies to Saeed's point, which is a really good one. What if you're a bank out there and you're having to design some stress tests, I mean, beyond the oil shock, beyond how concerned are you at all? We did talk about inflation. We talked about sort of slow growth. Is stagflation even sort of it's not even a high probability event, is it for you at this point?
Well, stagflation in the context of the 1970s and early 80s, no.
No.
If that's what you mean by stagflation, I mean that was double digit unemployment,
that's right. But maybe a milder flavor of that, maybe.
Well, don't you think that's what we're experiencing right now?
Yes.
I mean, if I told you inflation is in the 3 to 4% range and growth is 2%, and we're not creating any jobs, that feels stagflation-esque to me.
Yeah, maybe not like the 70s so much, but it's there. It's there, right?
Yeah. I mean, I would call it stagflation-esque, stagflation-ish, stagflation light. In fact, on I had a podcast. I'll advertise my podcast, Inside Economics. We had a session on stagflation, and we debated. My co-host, Chris Dorides, you know him well, the group does. And he's on the podcast. He's a co-host. And we debated for about 15 minutes, stagflation-esque, stagflation-ish, stagflation light. I can't remember what we decided, but they all apply.
Feels like it.
Yeah.
Yeah.
Absolutely.
So if you're a bank, I mean, you got to kind of dial up all these various stress tests. I guess what I'm hearing you say is maybe, a really sort of outlier here would be a more elongated type of war outcome, but again, very low probability.
Well, yeah, but some of the elements of the 1970s stagflation are with us. I mean, there's uncanny some of the similarities. There's differences, but some of the similarities. Yeah. I mean, one is, well, it's an oil price shock. Very same thing happened in 1973 and 1978, oil price shock. Second, Fed independence was a question. I mean, we know that Richard Nixon captured Arthur Burns at the Fed chair, and the Fed was overly aggressive with regard to monetary policy for political reasons, not policy reasons, and that wasn't helpful. We were running large budget deficits, related to war and everything else, and juicing things up that way. So, we can't completely. And there's a lot of things we're doing that are. This goes beyond there are other supply shocks that are occurring that go beyond the Iran war. There's the tariffs effects that's a supply shock, meaning higher inflation, lower growth, and the heavy-handed immigration policy. Same thing. It means much slower growth. You can see it in the labor market, labor supply, and higher inflation, higher costs. So all these things that we're doing exacerbate the potential for a stagflationary environment. So will we get to double-digit unemployment? Probably not, because the one thing that's different from today than then is we do understand inflation expectations, how important they are. And I think the Federal Reserve ultimately, no matter who's in charge, will, as I said earlier, sacrifice the economy, jobs to the altar of stable inflation. So, because they know if they don't, we are going to have the 1970s and 1980s. But I don't think we should take anything for granted. I mean, look at the policy mistakes we're making. Is this the end of it? I'm not, I don't know. I mean, I'm not sure.
Yeah, yeah.
So Cliff, just from the sort of the financial sector, the banking industry perspective, it's interesting when you speak to banks, in terms of scenarios, right? One of the things they do is, you're conditioned to think in terms of, interest rates and scenarios, right? But where the sort of the GDP and the labor market, how it manifests is in terms of delinquency rates. And it's interesting because for a while now, from the time sort of the Fed started raising rates, um, uh, the banks have tightened lending standards, right? And they really haven't relaxed in any substantial way. Um, and and then loan demand has also been impacted, right? So if you look up across the swath of the banking industry, there isn't much activity happening in the context of real estate, residential real estate. Very little in the context of CRE, because all the commercial real estate is all AI, which is capital market funded, I guess. And then what's left is what's driving the US economy is consumption, the consumer. And the sentiment surveys are just not helpful anymore. So it just comes back to sort of the labor market and what will happen in terms of delinquency rates, I guess. So it's an odd place to be as a banker these days because you're not getting any loan. The asset side is not growing, and the risks on the rate side and inflation are there, but that's something that banks can manage. What you don't control is delinquency. So that's just something you hear from banks. Just one of the perspective, I was speaking to a banker out of San Antonio last week, and I asked him, "Hey, what are you seeing in the oil? There's a fair amount of that," and he was talking about he drives regularly between San Antonio and Houston, and there are all these oil rigs, which just dot the landscape, right? Been there for decades. And for the past since the Iran crisis started, he's been seeing a lot of them go operational. But they're the low-cost ones, right? These are there, just easy to turn the switch on, doesn't cost them much in terms of running them, I guess. So that's on the margin, doesn't move the needle. And what that tells you is that people are being very mindful. Oil producers in the US, to Mark's point earlier, they're not rushing in to increase more production because they want to watch and see where the prices go, I guess,
Yeah.
from a longer term perspective. So.
Yeah, there's a lot going on there. One of the things, and I'm going to shift gears a little bit away from the oil side, because there's been all sorts of other effects, right, for other types of commodities and whatnot. But one in particular that caught my attention, and I know you guys have been following this, is we've seen, you know, kind of a switch from where gold usually is in these times of crises or whatever you want to call it, right? It's dropped, I don't know, somewhere around 10-15% or something more recently, and you kind of think of it's traded like more like a risk asset than like a tech stock almost, falling as the conflict really kind of intensified. So is this just kind of a temporary aberration kind of thing? Or cash is king, everything else, even gold, just as a source of liquidity? Well, what's going on there, do you think?
Is that
I happy to
Hey,
go
Cliff?
first. So we were tracking it and we were surprised because I agree with you. I think we do a weekly data bank, and what we showed last week was cash is king. That's where the dollar is strong, and that seems to be the sort of the safe haven in some sense. And gold is being very counterfactual this time around. And if you think about gold, where some of the demand comes from, the Middle East is a big consumer of gold also, right? Think of Dubai. A lot of people actually buy gold, and people from India go to Dubai to buy gold, and that's not happening, right? It's like the retail transit flows, through the Middle East, Dubai and Abu Dhabi and Qatar are pretty big flows, right? And they're all shut down. Nothing is happening. The planes are not flying through those airports anymore. And is that one of the reasons that the retail demand from Asia is slowing down because they have other things to worry about and they can't even get to Dubai if they want to buy gold?
Mark, what do you think about gold?
I hadn't heard that explanation about the Middle East, but that makes a lot of sense. I mean, my explanation was interest rates. I mean, when rates rise, gold looks less attractive, right? Because there's
Yeah,
no yield on gold. And that then says that leads to another surprise, and that is long-term rates are up to the degree that they are, which I guess you can explain in part by higher inflation expectations. Although if you look at five-year forwards or five-year break-evens, you don't really see that. It also could be, though, that the U.S. is losing its kind of safe haven status.
yeah,
We are deglobalizing. We're pulling away from the rest of the world. The rest of the world is pulling away from us. That means the dollar is less central to the global financial system. And I don't want to overstate the case. We're still the reserve currency, and I'm not saying that we're going to lose that. But it reminds me of that old Hemingway quote, that book. I can't remember which one of the books. Sun Also Rises, maybe, where one character was asking the other character how did he go bankrupt? And he said, slowly at first, and then all of a sudden. That's kind of sort of how it feels to me.
yeah.
So, and the dollar has appreciated a bit in value, but less so than I would have thought in the context of the
Right, right.
uncertainty here. So it does feel like maybe we're losing a little bit of that safe haven status, which means higher rates, and that might be, that's a kind of a long chain of events to get back to. Well, maybe that's one reason why gold prices have moved in a direction that feels counterintuitive. The other thing I'd point out, though, is that, as you know, all precious metal prices, gold, silver, others, they had taken off, right?
Yeah.
Prior to this, and they had been just starting to correct. So there might be other kind of market dynamics at play, speculative players in and out of the market that are, exacerbating, these price movements. And, as economists, we try to explain everything, but at the end of the day, it could be something as simple as that,
Yeah.
a flow argument.
Another esteemed economist who is listening in here, Mike Fratantoni.
Mike,
I don't know how we didn't rope him in. I think he might
yeah.
have been the one that was the impetus for these webinars, actually. But Mike fired a question in here, and it kind of goes I mentioned at the outset of this webinar some of the issues of the conflict around semiconductor production, right? Helium,
Yeah.
a lot of things going on there. So how big a deal is this for countries like Taiwan and China, chip manufacturers? What does it mean for AI developers, data centers, and that whole ecosystem? So what do you guys think about that?
So you want to go first? You want me to go?
Why don't you go, Mark?
Well, I think it's important, but let me preface it by saying just something that I recently learned that adds to my concerns about inflation, and that is that contributing to the run-up inflation that we're experiencing, and really the surprising acceleration in inflation in the last few months, even before the Iran war, is the price for computer, electronics, chips, anything that goes into a data center. Demand obviously is through the roof, and that's driving up price, and that is now contributing to overall inflation. The PPIs, the producer price indices for those different types of electronics, have gone skyward, and they are inputs into the consumer expenditure deflator, the measure of inflation that we've been talking about, and the Fed uses. And that goes back more fundamentally to the point I made earlier about AI demand is outstripping AI supply. So AI is lifting demand more than supply at this point in time. and that's inflationary. So ironically, right now in the current inflationary environment, adding to that inflationary environment is what's going on in the tech sector, chips and everything else. Then you throw into the mix, what's going on in the Middle East, and that is affecting things that go into electronics. Aluminum is a good example. The
Right.
Bahraini aluminum plant got nailed, and so aluminum prices are up. Helium, I believe, a gas that's produced because it's these are all very energy intensive, products, and that's why they're in the Middle East. That goes into the production of chips. You need that gas and other types of gases. And I do think there's a growing concern in the chip industry about the disruptions to their supply chains and the higher prices they're having to pay, and that's just adding to the angst in the potential fallout from all this. And just another reason why this thing has got to come to an end pretty quickly. Otherwise, we will suffer an economic downturn.
Well, but one of the things about this too is, I mean, it's also agriculture, right?
Yeah,
With
yeah.
like fertilizer production. I mean, that seems like that's a big deal, and I see people talking about it, but I mean, that with planting season on us, right? At least here in this country, that seems like that's a big deal.
Well, grocery prices generally, but first it's going to be diesel, right?
Yeah.
Diesel is up more than gas, right? It's up $1.50, I think, last I looked. And that goes, the one of the highest cost components of groceries are getting it from the port or the farm to the store shelf. So you got to truck it, you got to put it on a truck, and so that's already going to happen. And then you throw in the mix the cost of fertilizer, urea, which is a synthetic, product that goes into fertilizer, is very energy intensive, natural gas intensive, and that is now at a higher price in short supply, and that's going to flow through, going forward. So just other reasons to be nervous about the inflationary effects of all of this.
And just adding on the ag, we spend a lot of time on the ag sector, ag lenders. We have an ag conference every year, and for through 2025, the farm economy has been struggling. Think about what happened to soybean for our exports. We used to export a lot to China, and that stopped because of the tariff policy and others. So there have been a lot of headwinds in the farm sector, and all of this just adds to that in terms of it. So on the producer side, this is a negative. And then on the consumer side, also, this is a negative. It doesn't. And there's also, I think, there are reports coming that many of the consumer good companies and processed food companies were thinking about beginning to cut prices just before this whole crisis started, and now they all sort of paused, right? So if anybody had any plans of cutting prices, those have been mothballed. So this doesn't help the inflationary situation. The other thing when I'm thinking about more longer term is supply chains, right? And is there's a recalibration that's going to happen? And do we start looking for helium suppliers? Because I think the US and Bahrain are the sort of the two biggest suppliers of helium, I guess. And other do we need to sources from elsewhere? China has now started producing its own helium, and so there will be that diversification that's going to happen, but all of that comes at a cost, right? There's no free lunch here. So from inflationary pressure, I think that's going to be there for longer, I guess.
Yeah, absolutely. I'm keeping an eye on our timing, and I want to give our audience a little bit of time to kind of weigh in on this. I've got a question I'm going to kick over to both of you. It's a long one, but let me just kind of read this out here. I'm very curious on the currency devaluation in the event that the petrodollar diminishes. We've seen events where Iran has sold oil to China. This threatens the U.S. petrodollar. More concerning is gold back was removed, and we rely on the petrodollar. Will this result in a collapse in the economy of the petrodollar if it diminishes? Specifically, I guess this is the question, How can it impact financial institutions' liquidity among bank runs, GDP, and inflation? Would the Fed step in and implement QE or other approaches to counteract this potential impact, or what can we expect? Is this a plausible fear? There's a lot to unpack in that one.
Yeah, I'm not sure if I'm interpreting the question correctly, but my interpretation is kind of where I was going in the last part of the conversation around the safe haven status, reserve currency status of the U.S. I mean, I think that's the point of the question.
Yeah,
Do I have that right?
yeah, I think so.
Uh, and I don't want to be overly alarmist. I don't think events are leading to some type of cliff event where
Yeah.
the U.S. loses its reserve status because it's unclear where the money goes. What would replace it at this point. But I do think it's a corrosive. It's one of those things that over time the dollar, the reserves held in dollars will continue to decline as they are. If you go look at the U.S. The share of reserve assets that are in dollar in the dollar, they've steadily declined over time. It's still well over half. I think it's closer to 60%, but it's well down from where it was. And as I said earlier, I think we are doing things that will continue to contribute to that. The reason why the dollar is the reserve currency is because we supported and developed a globalized economy. I mean, coming out of World War II, we developed all of the institutions necessary for an economy that was globalized. The World Trade Organization, the WHO, the IMF, the World Bank, on and on and on. And that resulted in further integration of the global economy and financial system, all centered around the US dollar. But now we're moving as fast as we can away from that globalized economy to a deglobalized economy. That's the point of tariffs. That's the point of heavy-handed immigration policy.
Mm-hmm.
That's what to visas, to making it difficult for foreign students to come here and stay here. All those things. Even things like freezing dollar reserve assets, because you're upset about a country with policies that don't agree with your own. All those things, make you less central to the global financial system, and therefore the dollar will continue. And the events in the Middle East, current events, will do the same thing. It will shift supply chains and who's trading with whom and to what degree, and that means the dollar becomes less central. And the kind of the network effects that keep the dollar as the reserve currency slowly erode. It's a corrosive, and then at some point they break when there's an alternative. Again, I don't want to be overly alarmist, and I don't think that happens in my lifetime. I don't think, but that's certainly the direction we're headed.
Yeah. No, I completely agree with Mark. I think the bigger concern, I think Mark, you nailed it, which is international trade has been impacted in a big way. And I think the price of that is much more than other currencies being used, or the shrink or the reduction in the share of the US dollar in payment flows and stuff like that. I think that's just a nominal factor. I think from an economic impact perspective is the fact that there's a lot less, more protectionism in some sense, which is the bigger problem, I guess.
Yeah, yeah. And we're going to in the next two webinars, this is a shameless self-promotion of CERC's upcoming two webinars in this space, but we're going to spend a bit more time diving into some of these issues with particular focus. And we didn't get the chance to talk about it today. But I was going to ask you, Sayee, that, on banks' minds, in addition to delinquencies, that I would think they've got to be thinking about cyber risk.
Yeah.
Been a lot of chatter and things going on there, right? So they probably are kind of got their antenna up
Yeah.
in a big way on that. But also again, more discussion. Well, so we're gonna have a session on cyber risk coming up, and we're gonna have another deeper dive into the energy implications, and we're gonna get some folks that are, for example, I think we have Chevron's chief economist coming on for that one to kind of go into it. But what I'd like to say, at least to kind of wrap things up today, is appreciate both of you taking the time to come on and kind of imparting your wisdom to all of us about how do we get our head wrapped around events that are changing on a minute by minute basis. It's like I'm kind of like glued to the screen almost in terms of what's going on in markets and whatnot. But thank you for doing
Not
that.
me, Cliff. I turn it off.
I should probably do that. Yes.
That's why you're not sleeping.
That's true. But in any event, again, thank you both for joining with us today, and appreciate the audience joining as well. These are being recorded, and so they'll be this one, I don't know when, but in the next day or so, I think I would expect to have the recording up on the Cirque website. So if you want to kind of catch that there, you can. And I hope you enjoy this one, and then we'll join the next two that we offer. So thank you.